show. Shooting the breeze with Chris and Gene. All right, we made it. We're live. Okay, let me pull up the questions. Thanks everybody for submitting questions. We got a bunch over here on the forum side, and we have a bunch in the school side. And I think it's probably best to just start talking out loud in words. Okay, you ready, Chris? Here we go. This one comes from Andres. Yes. Hey, Chris and Gene, the top five highlighted, the big five, inside the newsletter, highlight some stocks from the Hong Kong Stock Exchange. I'm using Interactive Brokers by Lynx Broker, which is a German firm. And I'm unable to buy some of these stocks. I asked the customer support for the reason. They told me that I do have permission to trade on the Hong Kong Exchange, but this particular ticker 1568 is blocked in general because they detected what I guess is a pump and dump scheme. Scammers encourage investors to buy the illiquid stocks and then dump them for a much higher price. Therefore, the trade of the symbol is not possible, and they cannot tell me for how long this restriction will last. So no wonder it's so undervalued. Anyway, you run into this problem, Chris, with some of the picks?
Yeah, there's something weird. Well, okay. Firstly, this is specific only to US clients. You can be running IB, and if your domicile of your account is not the US, it's a non-issue. You can trade any of these stocks, and there's no issue. So you could question whether that's a political thing or whether it's something else because it's solely on Hong Kong stocks. We don't really know. But it's if you're, it's Andreas is the person questioning. So Andreas, you'll presumably be domiciled in North America, and that's why you're getting this. I don't know why IB's doing it. I don't know. It doesn't make any sense to me that they can do it solely to US clients, but then they wouldn't do it to Australian or Singaporean or anyone else. But which is why I'm sort of err on the side of potentially there's some sort of political interference or something there. I'm not sure, but there's not much you can do about it, basically. Short of if you are a North American.
How about EU? Because he's using Lynx Broker, which is a German firm, which kind of makes me...
but it's just that's a white label. It's Lynx Broker is just a white labble for IB, which
could be anybody using it. Then,
sure US clients can still. I'm not. I'm not sure. I do know that where you've got an IB account through Dubai, Australia, Singapore, it's a non-issue.
Okay, we'll leave it at that because about as much as we can do there. Rick asks, hey, Chris and Gene, within the week's news of the bribery claims against Melee's inner circle, including his sister, spiking, I'm curious, what's your take on how this mess will affect Argentina stock exposure going forward? Thanks, Rick. Yeah, I know he was attacked the other day. At least that's what the headline said during the parade.
Look, this is Argentina. I mean, that's like it's just another Tuesday.
Yeah.
No, look, if you look at their history, that's always how it's been, and it's been priced probably accordingly. So maybe it becomes something. I go back to the core stuff. You were buying companies. The companies have the valuations. We like the valuations, the cash flows, and everything else. Now, the trajectory that Argentina are on is obviously significantly different to that, which was pre-Milei, and it's positive. Does this derail that to some degree? Possibly, but we'll find out in, I guess, the elections coming up. But for now, there's nothing that I would change in terms of, politics is politics. My suspicion is those that are pro-Milei are going to continue to be pro-Milei, and they'll see this as being a political interference from the left, even if it's not. As to whether he's corrupt, almost certainly. I think all politicians are corrupt. I think it's almost a requirement to become a politician is to be a corrupt bastard.
Yeah, right. Good point.
So there's nothing that I'm doing or that we are doing in Glenorchy or in Insider accordingly.
Just kind of waiting it out, see what happens. Okay. Off to the next one here. Thank you, Rick. War Beaver, great name. Hi, Chris. What are your thoughts on the chemical industry? It appears to be struggling and potentially at the bottom of the cycle. Some of the publicly traded companies in this sector seem to be developing some asymmetry, but the businesses themselves seem to be navigating significant hardships. What would you recommend a deep value contrarian look out for to assess opportunities in this sector? Let's go back.
Yep, valuations. So we actually looked at the chemical space. We had this similar question some time back. It's getting cheaper. It's not cheap enough, frankly, for us. There's a couple of companies that are very cheap. Sasol, which is a South African chemicals company, trades about a P of something like 4, but it's South Africa. So to some degree, that's pricing it, differently to a company that is in, say, United States. I come back to the statement that Jim Rogers famously has said, which is that bottoms in markets typically last 10 to 15 years, not 2-3 years. And I think that's true of the chemical industry. The other thing with the chemical industry is I personally find it quite a difficult industry to actually ascertain, to figure it out. It's when I take something like shipping, it's like it's easy. It's like, what is the level? Like, what is the inventory at the moment? What are the lifetimes of the vessels? We know how long they last. We know that when they're going to start getting scrapped, so we can go forward looking and say, okay, in 5 years' time, we're going to have scrapped 30% of the supply, or whatever the number is. And then we can look at the new builds, and we can see how many new builds are coming on, and then we can see current demand and cash flows and debt levels. Like, it's easy. Chemical industry I find a lot more difficult. So, but that's not to say we wouldn't invest in it. It's not cheap enough for us now as an entire sector. There are some companies in there that are representing value. But yeah, back to Jim Rogers, it's like we like washouts where something's been down and beaten up and left for dead for like 10 years. Typically, that's our favorite thing, and across the sector. So not just sort of individual few companies, which is kind of where we're at now.
Yeah. So a tsunami needs to hit this thing, and then you just got to wait for the tide to go out and see who's standing, and then see how long they stand, and if they're still standing after a while, maybe it's time.
Yeah, and you see a lot of M&A activity where you have, and the M&A is because companies are struggling with cash flows and they go bankrupt, and the creditors, you have restructurings taking place essentially. So I'd want to see more of that on a sector-wide basis.
Yeah, makes a ton of sense. Okay, jumping to the next one here. Stefan asks, hey, Chris, what are your thoughts on how to invest in the uranium space for a generalist investor? Is it better to invest in miner ETFs or the Sprott Physical Uranium Trust? Looking at Cameco, CCJ, for example, right now, it's currently priced at a PE ratio of 85, according to Yahoo. And looking outside Cameco, most of the companies don't even make any earnings. They have negative earnings, and the miners just seem highly speculative to me, and you take a lot of operational risk with each mining company. I've read of several companies not meeting production forecasts, such as Encore and Boss Energy. So with all that being said, I believe the safer bet is just to dollar cost average in the Sprott Physical Uranium Trust. Miners seem like they require a ton of due diligence. Yeah.
Yes, to some degree, I agree. I mean, look, uranium, we were buying uranium back in 2018.
It's been a while.
Cameco, for example, I think it trades a P of 89, not 85, but it's not particularly sort of cheap. We did take, and people would hopefully remember this, we took off quite a bit of capital off of our uranium position and repositioned it. We've gone into subsequently things like Chinese small cap equities and platinum and some other stuff, which we feel has a better asymmetric bet. So we certainly made a lot of good money in our uranium trade. We still have, I think it's about a 4% weighting in it, but we've more than made all our money back already on our original investment. So it's not cheap like it used to be. There's a lot of arguments one could make as to why it could get more expensive. Like, I'm certainly not bearish uranium. It's just not the same trade that it was in 2018.
Yeah.
And keep in mind, when we bought it, I think our uranium position went down maybe 30-40% before it went ballistic. So anyway, so that's our uranium thing. I agree with you on the fact that you have a whole lot of operational risk with respect to the miners, and that's always true. It's much more a cyclical kind of industry, so it's more speculative in that respect than something like tanker stocks or chemical companies, I suppose, like we were just being questioned about before. So if you want to take some positions in it, then you could either buy the physical uranium trust. If the sector is going to do well, the companies will likely do well. So you could just buy URNM. I think it's got maybe 10% roughly weighting into the physical uranium trust anyway.
So you get the best of both worlds in there.
Yeah, it does have. Oh gosh, I think it's 16 or something percent is into Cameco, which is not cheap. Again, it's for us at the moment. It's like a position weighting decision. We still feel like in the energy space, as people realize that, oh gosh, wind and solar is not going to work, there's likely to be a continued flow of capital towards the alternatives, of which uranium naturally is one of them. And so we don't want to take all our chips off the table. We've certainly made more than our original investment back on all that anyways. So we're happy enough to sort of sit and have a small positioning in it, but sort of to some degree as an overall fossil fuel theme, if you will, as opposed to making a call on uranium and saying, well, this thing is amazing. We think it's fantastic, which we did back in 18.
Yeah. Makes a ton of sense. Transition there. Okay, let's see here. On to the next one. Mark asks, hey, Chris and Gene, quick one today. I'm seeing similar blurb / confidence around silver. Yeah, as there was in the past around Bitcoin, as in no matter what happens, it's up, down, left, right. It's bullish for Bitcoin. Hold, buy more. So yeah, a lot of talk about silver right now. I'm not especially excited about silver. Hate precious metal miners. And the question is, how do you manage, I suppose, confirmation bias when you're managing a few contrarian stocks? Grateful as always, Mark. Yeah, you just kind of chalk up the whole silver thing to just a bunch of noise by retailers, or do you think there's something actually to be said about investing in silver right
now? Firstly, we're not invested into it. So this is me talking. I like to talk about things that we own, right? Because then I can say, well, this is why we own it, rightly or wrongly. We don't own silver. We don't own the silver miners. So just putting that out there. It falls more into the monetary debasement end of empire, end of fiat regime kind of question. In that environment, it's hard to be bearish on silver. It is still to some degree a monetary instrument, far less than gold. And that's unlikely to change. It's wildly volatile. So to that degree, it's more speculative for traders, which we're not. They'll put those, which is why we don't own it, to be quite frank. We own a lot of the miners, which have as a byproduct, some of them have silver in them, So if you go and you buy GDX, there'll be a number of miners that are not just gold miners, right? So they have gold and they might have 10% or 20% is also silver. So keep that in mind. For us, that's sufficient exposure into the silver space. It's not something that we've speculated on or intend to speculate on. And so that's pretty much it, really, Mark. What else can I say?
Hey, if you don't own it,
how do we manage confirmation bias? Like, it's kind of simple. Well, if you try to train your mind to always look for where you could be wrong, as opposed to trying to confirm where you're right, it's just take away the hubris, take away the ego, which is always, I've thought, the most dangerous thing to any investor. And the basis for those are often valuations and relative valuations. So like you can go into the sector and you can look at the particular companies and go, are these cheap or are they expensive? And you can look at long-term charts and you can kind of see, yes, they are, no, they're not. And that's a very rational decision. Like, it doesn't require you to be, confirming or not confirming some bias. It's just looking at it saying, are these cheap? Are they expensive? End of story. And then if you're allocating, as we do, relatively small percentages to these sectors, I just find it much easier to not get caught up in a story around any of them, it's let me put it this way. So we've got, a small hobby farm. I got a dog here and a couple of cats. Now, there are pets. Like, if something happens to them, I'll race them down to the vet, and like there are pets.
Mm-hmm.
And then I look at some neighbors who got farms, and they got like 500 cattle. They're not out every day checking to see if the cattle are kind of okay, and are they right, Fluffy?
That's their mental health today. How are they
No,
feeling?
it's like they're not really worried about them. Now, that's not to say if something goes wrong with some of the cattle, they'll probably get the vet in and see to it.
Sure.
But it's a completely different way that they view it. They view it as cattle, and they don't want to lose a head of cattle. But if they do, they go, well, it's like 1% of 500, steers or whatever they've got. Whereas, so that's very different to like, oh, I just lost my dog.
Right.
Right.
Yeah.
Now, the lost my dog thing is what happens when you've got a 30, 40, 50% allocation to one thing, right? You're in love with it. Like, you have to be in love with it. Whereas if you've got 500 cattle and you lose one, it's like, obviously there's a human element then. You don't want to lose animals or another creature on the planet, but like, it's just a different way to view it. I like to have a portfolio that I can view in that fashion, because then I'm dispassionate about it. I'm like, I'm not caught up in whether uranium is good, bad, or I'm like, it's a percentage. Like, what does it look like? So that's, I think, the best way to manage that confirmation bias, mental, fuckery that you can get your mind into that people do.
It makes a ton of sense. You can't get emotionally connected to these things. And like you said, the best way to do that is to keep yourself busy with other things. And if you're obsessed over something you have 30 to 40% interest in, it's not going to work out in the end. Promise you that much. Yeah. Okay, cool. All right. Let's jump into the next one here. Thanks, Mark. Anthony A asks, Chris, I hope all is well. What's your outlook for these stocks? So he's got three things here. He's got, what's this? Pyxis tankers,
yep.
PXS, and then Transocean, which is RIG, and then Cetrium, which is SMBMF. Yeah. Have you looked at these recently? And what are your thoughts here?
All right. So Pyxis is quite different companies here. Let's start with Pyxis. So that's a product tanker. It's a call on the product tanker market. Now, if I was to make a call on the product tanker market, I wouldn't just buy Pyxis. I would buy that. Sting is the Scorpio. The ticker is Sting, STNG. Scorpio Tankers is the largest. It's like $2.5 billion market cap. They're going to be very different. Pyxis is, from memory, $30 million market cap, somewhere there, maybe a little bit less.
Small. Yeah.
Very different, right? Now, but again, if you're making a call on the product tanker market, I'd definitely own Sting over Pyxis. Right? So that's and yeah, if I'm going to make a call on product tanker market, I'd own Sting, which we own a little bit of right now. As to what's the next one? Rig. That's offshore oil and gas drilling. Okay. Now Rig's not that cheap. There's other ones you can look at. We don't own it. There's other ones that we do own that I think are probably better value, which is Valaris, Noble, both of which have no debt because they went through bankruptcy. Rig didn't. So they cleared the decks. That they got that. We had that beautiful washout. There's another one, Seadrill, you can own. So that's the offshore sort of oil and gas drilling space, which we like. Cetrium, that's the old Semcor Marine. They're a company in Singapore that do shipbuilding and sort of offshore engineering. Your call on them is basically a pickup in the offshore oil and gas capital expenditure. We like it. So that's it.
Okay. All right. There you go. Got your update. Okay, let's jump into the next one. Thanks, Anthony. Lance asks, hey, Chris. Hi, Gene. Hi, Chris. Hi, Lance. With Powell signaling that rate cuts will be starting in September, what alternatives do you like to T-bills and short-term treasuries if real yields start to go negative? My equity allocation is highly diversified across value-oriented stocks that pay nice dividends. I'm close to retirement, so I'm not looking to increase my equity allocation higher than it already is. Just looking for fixed income type of investments with low vol and positive real yields if the time comes to start moving out of T-bills and short-term treasuries. Thanks, Lance.
Yeah, to some degree, this is the question that a lot of our Glenorchy clients asked us back in, 2020, so 2021 was when we launched our dividend income portfolio. That we run for Glenorchy clients, and then we talked about it a bunch in the Insider. And the question was basically, hey, we're worried about bonds. You guys think bonds are all garbage, or they're very dangerous. What do we do? And our answer to that was low valuation, high dividend yielding, typically medium cap to small cap companies. And the results of that are pretty much in now. So we've been running that for 5 years, and it's been really good. I mean, we've outperformed every dividend portfolio that we can find. And I'm not just doing this to pat myself on the back. I'm just saying there's a structural reason, I believe, why it's done well. Firstly, we are owning the companies that other large pools of capital cannot own. And I've said this before. I'll just repeat it because it's I think it's not that like that we're geniuses. I think it's just more a structural thing. Sure, we can go and find cheap companies with low valuations that have got no debt and they're printing money, and there's a lot of them, but they're not in the large caps, and they're not in the large caps because all the large caps buy them, the large institutionals can buy them. So that aggregation of capital that's taken place over the last 30 odd years has been into passive capital. Mike Green talks about this, right? When he was at Rebel Capitalist, not last year, the year before, he highlighted how this is a real significant risk to the markets. And I agree with him. And I think that risk is increasing. It's certainly higher today than it was when he gave his speech in Orlando. But the point is here that when or if we get some big equity sell-off, they'll sell what they own. The companies we are buying and buy, they don't own them. I'm not saying they won't go down. I'm just saying structurally, the huge amounts of capital that are invested in the world are not invested into these size companies and so we see that as being a risk mitigation. That's the first thing that you want when you're looking at, because the question you have to some degree is, hey, I don't want to lose money. So what's his name?
This is Lance.
So Lance, you're saying, and I get this, you don't want to lose capital. So you're not really looking to increase equities, right? Because historically you would buy equities for growth and you would buy bonds for protection. I'm saying bonds for protection are a wrong bet, right? Because of the tail end of the bond market, bond bull market. Certainly that seems to be playing out. If you're invested in, so like our dividend portfolio, go back, say, call it 5 years. You would have lost roughly 50% of your net wealth if you were invested in bonds, 40 to 50%. That's significant. Okay. That portfolio we're running has kept up with the S&P 500 while the S&P 500 has been on fire, and it's completely uncorrelated. It's not invested at all and it's with I would also add significantly lower volatility than the S&P. Now, anyway, the point I'm making is that our answer to the question that you're putting forward is to buy deep value companies, actual companies that are paying solid cash flows with cheap valuations. We will take equity volatility risk over bond default risk any day at this point in the cycle. So that's our answer to that. Your question is sort of around short treasuries and T-bills. I don't like either. Treasuries provide liquidity. They're fine when you're sort of sitting there scratching your head, wondering what to do with your capital. Ultimately, the value of currency is being devalued on a regular basis. The CPI is garbage. Even by CPI standards, your yields it's hard to keep up. It's hard to find yield in a traditional fixed income products that are exceeding CPI, let alone actual inflation. So you're kind of guaranteed to lose money. You can do that if you just want the liquidity, right? Fine. It's just, it's a problem for me in that you realize that's not a trade I want to make on a long-term basis for multi-years. If I need capital in the next 12 months, I'll be like, fine, I'll just go into something super liquid and buy my T-bills and just take the fact I'll lose a little bit of money and it's cool.
Cost to carry.
So yeah, that's my answer to that.
It makes a ton of sense. So Lance, if you wanted access to say like your dividend portfolio, your model portfolio that you guys run over at Glenorchy, Insider would be the way to go. So you have to become an Insider member, but you get access to all that. And then if you just want him to manage your portfolio for you, that's the Glenorchy side. So it's really up to you. Okay, moving on to the next one here. Thank you, Lance. Jacob asks, GEOS, this is Geospace Technologies, has ran like the police are after them. Time to trim down some or let it run some more. Yeah, what's going on there?
Okay, so we bought and we own Geos from yonks back. It's been, look, if you take a short-term chart, it looks like it just took Viagra. But it's only back to kind of where it was pre-COVID. So like we were buying at, I think, $8 or something in Glenorchy. It's 20 odd today. So it's okay, it's gone up a little bit. But if you look at the long-term chart in this, it's got a long way to get back to like kind of previous highs. Additional to that, this company has had no dilution. They haven't needed to raise any equity. They're profitable. They got piles of cash on hand. They're perfectly set up. So I'm not selling them at all. It's, people will often look at a stock chart and then try and make a judgment call based on the movement of a stock chart or a price. And they'll say, for example, a company that's $2 is cheap and a company that's $4 is expensive. And there's no understanding of what's the free float or what's the market cap or any of those things. You can have a company that's $400 a share and it's way cheaper than one that's $2 a share. Depends what's your free float. So there's that, and then there's just the movement of a stock price, which isn't the whole story. So again, the whole story, at least as we see it, is got piles of cash on hand with this company. They're profitable. They it's in the right space. It's in the right space for the fact that the world seems to be waking up to the fact that, hey, we might need proper energy.
Makes a ton of sense.
Hold on.
Yeah. Hey, it's funny because I was just thinking about your analogy there, and I'm like, yeah, I used to do that. I used to chase the cheap price, thinking that it was cheap. Like, a lot of us have to learn that the hard way what that means.
But you see that, and who's really egregious in this are the mining companies. Oh my gosh, there's so many frauds in the mining companies. You get a boom in the mining market, and then what these guys will do is they'll just dilute shares.
Yeah,
they'll dilute the shit out of their stock, and you have all the retail guys coming in going, "Oh, he has this new mining company. This one's only 40 cents. Buy it at 40 cents," and it's like they just diluted the fuck out. It should have been at $4, but they just, So,
would you start swimming in the penny stock world? It's a bunch of pump and dump
stupid games. You get silly prizes. I mean,
the dilution is the part of the game, and you're the guy that gets to hold the bag. Not fun. All right, Thomas says, "Hey Chris, I was in Costa Rica for 3 weeks recently, and I have a real estate question for you. So I found a small house, a cabina, in a nice location. A cabina, maybe that's Mexican, maybe that's Spanish for cabin. It is currently rented out on bookings and Airbnb by its owners. I'd initially also only rent it out. So I wonder how the following metrics read to you from an investment viewpoint. So again, Costa Rica, a cabin, 40 square meters with an amazing view into the majestic nature of Costa Rica. Fantastic area, great community. The land itself, 5,000 square meters. It has a second buildable spot on the land for another, maybe granny unit, something like that. Currently rented out for 110 days, up to 150, 180 days a year on booking.com for about $90 a night. They're asking $150,000 USD, but there is room for negotiating. And based on Thomas's calculations, after all expenses, this includes the platform fees, cleaning water, electricity costs, insurance, all that stuff, as well as building that $1,200 of savings for future renovations, the net return equals about 4.3%. there is the upside of building that smaller cabin for $50,000 extra. I could generate the same cash flow or even better on Madeira for an investment of only $30,000 to $40,000 because we already have the land there and infrastructure in place. So also a mixed bag of those stocks you highlighted offer a better return with less hassle. On the other hand, Costa Rica offers residency in and out of the EU scenario. Yeah, so he's kind of weighing out the intangibles here. So my questions are, number one, how do you, from a metrics given above, feel about that property? Does it seem like a bad, mediocre, or good investment based purely on financials? And number two, how would you value a price, the optionality that comes with it, like a residence in Costa Rica and investment outside of the EU? And then as a final note, most of my money is invested in your asymmetric stock picks. I'd have to sell some of those to be able to afford this rental project. I'm pretty sure the good news is your asymmetric stock portfolio will be able to fund it because you've done so well.
Yeah,
But
there's
anyway,
a lot
what are
to
your thoughts?
cover. Yeah. Okay. Let me try and break it down. So we got the investment side of things where you've got rental yield. There's a potential to increase the value. That brings in two things. If you're buying a property and you're just getting rental yield, it's kind of like typically it's something you buy and you hold it for a number of years and it just pays you cash flows and it's all cool. Well, it's never all cool with
You're always
rental
dealing with
properties.
stuff.
You've had
Yeah.
rental properties like the take
Yeah.
management and there's always some issues. But
$10,000 bill once a year. At
yeah,
least.
but you take those issues and you accommodate for them and so on and so forth. But so based on an investment like that, I like to have a rental yield net of like, I used to go 10% and I wouldn't touch anything under 10%. Depending on the circumstances and on other factors, I would go lower. So in Dubai, I went a little bit lower because I went super high end. I wasn't so much yield. I was also looking at buying up cheaper assets at the bottom of the cycle. And so I wasn't as concerned with yield, but I was still renting them out. Okay. So I was, getting 7%, which has now dropped quite a lot down. But so there's that side of things. That's your rental income side. Now, the other is going and putting on another additional dwelling or something else like that. For me, like increasing the value, then you're going to do that and you capitalize it. It's basically a project. You go in, you maybe rent this thing out, you build another house and you sell the whole lot. Or you're building another house to increase the yield such that your overall net yield is higher. Again, back to overall net yield. If I can't get at least 7-8% net of expenses, why would I do that? I'd rather just own. I can buy dividend income portfolio and get way more than that without any of the hassle.
Yeah.
So there's those equations. Then you've got the residency, potentially a place outside of the EU. That's a different equation, right? That's not even. It's a different equation altogether. I will say this: if you are to get residency in Costa Rica, it's not that simple. I.e., you need to spend, and don't quote me on this, I think it's 3 to 4 months a year there to retain it. And so if that's viable and you can do that, cool, knock yourself out. Maybe that's worth doing. If it's not, then it's not. And then that whole part of that value of that equation just goes away and you're like, okay, I'm not doing it for that. I have to do it for something else. So
yeah, makes sense.
That's kind of helpful.
Definitely gives him some more perspective for sure, especially that whole insurance component of having the possibility of getting a residency outside of the EU since he lives in Europe, Germany, I think. Didn't you, when you did the Dubai thing, they gave you a dual citizenship over there?
No one gets citizenship in the UAE.
Oh, that's right.
For billionaires.
Yeah.
Sadly, which I'm not.
Give it a couple more weeks.
You can get a golden visa, which is a 10-year residency.
Okay.
And the requirements of that are you only have to be there once a year. There's other ones you can look into. You can set up companies there and things like that, and you only have to get there every 6 months. And there's a number of options, and it's one of the easier residencies to get in the world, absolutely for sure. And then it's a fantastic travel hub, so it's easy in and out. Like almost no matter where you are, there's flights.
Yeah, I can see the advantage for doing something like that. All right, buddy, let's hop in to the school platform over here. We have a few questions left to go. This is from Jacob. See that he's made the transition. Jake asks, hey, Chris and Gene, hope you are both well. What are your thoughts on hydrograph at current prices for at least a 5 to 10 year investment? And he's showing me ticker HG/HGCPF. I'm not sure. Have you had a chance to look at hydrograph?
I don't know anything about it. I know it's graphene. I think it's graphene
Oh,
stuff.
yeah. We had this conversation last time. Yeah. We were like,
I don't know anything about it.
Gotcha.
It's, that's basically into a sector which is it's like concept investing. I prefer to buy stuff that's easy to understand. It's cyclical. I can go back and I can map out the cycles throughout, hundreds of years or whatever. That's not the case of this. So it does look pretty interesting, but it just doesn't fall particularly into our wheelhouse. And I haven't looked at hydrograph, so I can't comment.
I remember you brought this up. I don't know. We probably get this like once a year or something, but somebody tries to get clever and they start to dip into, sectors and themes and stuff like that just are way out in left field, trying to find some edge somewhere, right? As if like that's gonna, and then you always come back with like, hey man, I keep it simple. I go with what works, what's always worked. What has it, all the data is there in front of me and I can make a better decision that way. And this is just a reminder that you don't necessarily need to get too creative in this environment. You can just stick with what we already know and dig around there because you have more information. Joseph asks, hey, Chris, hope all is well. My question is about setting a proper hedge. Could you give some examples of how to set a proper hedge against gold, oil, the market, I guess, whatever is easiest, but also more technical, like at what point do you cancel your hedge or start writing on your hedge and cancel your positions you're hedging against? Thanks for your time.
I don't hedge. Hedging involves typically buying maybe futures contracts or options or something else like that. Our hedge, if you want to call it that, is in diversification across sectors. So like in our portfolio now, in the asymmetric portfolio, you could say, okay, well, what's your hedge against tanker stocks? I don't have one. I don't go and buy. It's a 5% weighting. Why would I hedge a 5% weighting? I don't have risk. Like it's
already cheap.
You know what I mean?
Yeah.
That's my hedge. Now, if I had a 50% weighting, I'm like, shit, I got to hedge that sucker. If this doesn't play out, like, so now I've got to get all technical, and now I might start selling options against positions and yada, 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 yada. And like now it's really a full-time job. It's a full-time for me anyway, but like will be full-time as in I got to sit and watch the screens, and I don't play that game. It's play silly games, get silly prizes. I don't play that game.
Yeah.
So
ahead,
so my hedging basically comes down to the structuring of a portfolio. It's portfolio weighting. That's how we hedge. It's not down to saying, oh, we own this and we should have some opposite and contrarian position against that. That's what a hedge is. Often when you do that, you basically wipe out your upside to whatever it is that you've invested into in the first instance. Or you do what a lot of people do, which is they will set price targets and stop losses, which is okay to some degree if you're basically going into large, super large cap equities or into indices, none of which we're doing. So like if you're long the S&P and you want to hedge against it, well, then you're going to go into the futures market and you're going to structure some products to hedge against that. But we're not. So like based on the structure of our portfolio, there isn't a need for me to hedge.
Yeah. Well said. Well said. That's, I think a lot of people get that confused because I bet it's a funny thing. I bet a lot of retail investors, they listen to everything you say and then you go look at their portfolio and you go, why do you have 50% of your portfolio in GDX? That kind of thing where it's like, you need a position size. You need to diversify this thing out. You need to really flesh these things out. You can't be concentrated in 5 tickers and think you're doing what Chris is doing. That's not what he's doing. And I only say that because that was me when I first started with you guys. I was the same thing. I'm like, oh, here's 5 things. I'm just going to go full retard into them. And I realized like, no, wait, what are you doing, dummy? But let's pump the brakes and like figure out how to do this properly. And then when you're buying things cheap, they can't go much. They can go down, but they can't go down to zero. They won't go down to zero. And if you got 1 or 2% allocated to them, But hey, Joseph, if you really want to talk about hedging, like hedging, Brent Johnson is the guy to talk to because he talks about this stuff all the time. A position and a hedge are 2 different things, and he'll walk you through it. and he'll be coming on probably next week. Yeah, first week of September. So probably a good question for him. Tony Davis asks, hey, Chris and Gene, I hope you're doing well. Chris, I have a son about the same age as yours. I was wondering if you've introduced him to personal finance / investing, maybe a course or a book or a program to help him learn the ropes. If you personalize something for his use. My son doesn't seem to have much interest in economics and investing, but if something were unexpectedly to happen to me and my wife, I would want to make sure that he has a good foundation so he doesn't make dumb choices if he receives an inheritance at an early age. Not expecting anything to happen to me or the missus, but as a former risk manager, I'm always looking at a potential what if. Thanks for your time to answer my question, Tony. Yeah, it'd be funny, Chris, if you just handed your son a book and said, go read this, and then knowing he's your son. Yeah, you've done some things with your son, teaching him how to invest. You want to kind of expand a little bit?
Yeah, look, to some degree, I feel out of place to give, like parents, almost like parenting advice in some way. And I'm like, and there's a lot of grown adults that probably got better stuff they've done than I have necessarily. But well, what will I say this? I mean, I've got 2 kids and they're so wildly different. And for anyone listening to this, you've got more than one kid, like they're just completely different creatures, right? And so you have to deal with them accordingly, right? The biggest thing that I've tried, and will call me in 20 years' time as to whether I've succeeded, is to just get them to think critically. I think that's it's like that, teach a man to fish, not give him a fish. And so while they'll get handed a bunch of wealth and whatever, and I don't want them to cock it up and mess it up. More than that, I want them to be healthy individuals that are thinking individuals that don't need me or anything else. That's the best gift I think you can give to your kids. But it's how you go about doing that. Again, it's like they're such different animals, right? So it's a different process for each of them. But if I was going to boil it down to one thing, it's getting them to think critically. There's a whole lot of books that I've put in front of them, and there's conversations that you have. And certainly as a parent, you're influential in their lives on those things, and you hope you are. There's no one book that I would say go and get them to read this, because again, it's like, like I gave my son the book that I gave him, because partly he's a man, and the way his makeup and the way his brain works was, I've got lots of books, but one in particular that kind of I think worked and resonated was Can't Hurt Me by David Goggins.
That's a good book.
That's a great book. It's an easy book. It's not a hard read, right? There's a lot of other ones, and that book has got nothing to do with finances per se or anything. It's about mental resilience, determination, discipline. And those are traits that doesn't matter what you're doing in life, you need those. And so, but then, my son, he's a man, he's a boy, boy man.
He's a boy man. He's a young man.
Yeah. And so there's physical things, he's played sport and he works out in the gym, and so he can understand where David's coming from, and he can understand the achievements that he's made, and that can resonate. Whereas, with my daughter, she should get that, but it's not quite the same. She's a different person. So with her, I'll share different things. But the core to it all is to try and get them to establish discipline. Discipline kills skill anytime. There's plenty skilled, genetically superior individuals on the planet, and they're not always the ones that succeed the most. Those are disciplines. I think discipline is one core element to it. The experience of hardship, I actually want them to have hardship to some degree. It's in hard times that we build and that we experience and grow. But hardship can crush you. So it's a manage of it's the difference between going to the gym and building a stronger muscle as opposed to going to the gym and tearing the muscle.
That's
You wanna
where
try
Goggins
and
comes in though too, because it's the discipline of accepting the challenge and knowing that you
yeah.
can overcome the challenge despite the overwhelming odds against you that
Mm,
you build resilience from.
yeah. Yeah.
And I think you
Yeah.
you nailed it. But didn't you and your son have like didn't he save up some cash, $1,000, a couple grand or
Yep.
something, and you guys kind of built out a little
Yep. He
portfolio,
set up
bare
an account
bones?
and I
Yeah.
helped him into that, and then he monitors and so there's all those things. But look, they're
Mhm.
kind of easy. And
Okay.
but even there, I'm like, does that understanding what Goggins understands,
Yeah.
like
Yeah.
then you can do anything. You can
It's
set
the
up a brokerage.
concept. Yeah.
It's the concept. It's like if you got that level of discipline and mental clarity, like then everything's easier. Everything's easier. So it's not
Mhm.
like you now, would my son need to find someone who can help him? Sure. If I wasn't the guy, like if he's got that mental discipline and desire and drive, he'll find someone. For goodness, Chat GPT will give it to you. Like,
Resourcefulness versus just having
yeah,
resources is really a critical key point
exactly.
there. Yeah. Yeah.
So that would be my 2 cents on it.
Yeah, well said. I like that. Okay, let's jump to the next one here. Thanks, Tony. Robert asks, "Hey, Chris and Gina, hope you fellows are doing well. I've heard Chris express his interest in the Argentine market, and I was wondering if you could share some of his picks. I'm familiar with TEOS Telecom Argentina, but I was hoping to hear about other stocks in the Argentine market that have caught your eye. Thank you very much, Robert. Yeah, I don't think they have your unofficial Big Five over here tracker like we do at the forum. But you want to just kind of rattle off some of your Argentinian picks for Robert by chance? Just the
Sure. I mean,
Banco Macro is
there's about 5: Banco
yeah,
Macro, YPF,
yeah.
Loma.
There you go.
My brain's freezing now.
I know I should pull it up. Should have ours ready.
What else?
While you figure it out, I'll log into the interwebs here and see what I pull up.
I'll pull up my handy dandy
Capital gains portfolio.
capital gains portfolio.
Let's see here.
Can you hear that? It's like it's pouring with rain here, and it's.
I could kind of hear it, but I thought it was my outdoors. It's funny because
Okay,
I thought it was like traffic.
It's like because some of these microphones are pretty amazing. They'll
Censored.
cancel out like background noise.
Right.
Yeah. So what do we got? We got Banco Macro,
Cressy.
Cepu, which is Central Puerto,
Yeah.
Pampia Energy, and Pampia Energia, which is PIM, Banco Argentina, BBIR, YPF, obviously, and then Loma Negra.
Yeah.
So those all trade on the New York Stock Exchange.
Yeah, those are easy peasy right there.
Yeah.
Okay. All right. And I think between us rambling, I think Robert can get it together. All right. Let's move on to the next one here. Patrick asks, "Hey, Chris and Gene, it's difficult to keep up with all the news these days. I guess you can write an insider every other day." Yeah, I bet that's probably the biggest problem you have, Chris. Yeah. So 2 questions for tonight. Number 1 here, Cuppy wrote a great blog post on the day of a portfolio manager. Did you read it? And number 2, what are the main things or themes that you focus on the most, especially related to your portfolios? Kind regards, Pat.
Yeah, Cuppy wrote a hilarious one. I mean, it was a joke. He was like, was portfolio manager under Trump, and he's like, wake up in the morning, see what Trump's yelling about now, and like then he's like sanctioning someone, and he's doing like it was just you could read it, find it. There's
I gotta check that out.
Months back, it was hilarious. So it wasn't accurate in that. I mean,
he's being hyperbolic, right?
It was a joke. He was writing it as like a hilarious post, just pointing out how volatile the markets are and
absurd the beginning.
What do I focus on the most? Main themes. Look, we're always just looking at existing positions and seeing, do they still make sense? And then almost always looking for new opportunities of which you build these lists. And then at some point in time, you go, okay, that now looks like it's something that we would take money out of this and then put into that. So, for example, we talked about today, we had questions about uranium. Now, it's easy, and this comes back to part of the question that Mark had, which is how do you manage this stuff, right? If you didn't have a list of new things that you were interested in that had asymmetry, right? But you can't kiss all the girls, right? So you kind of just sit them on the side there. If you didn't have them, then everything that you have, that you own, is where your central focus is. Okay. And so now you're not even thinking, you know what? Like you might look at, say, uranium and go, it's kind of getting expensive. Like a lot of these equities aren't that cheap anymore. But your thinking doesn't go beyond that, because you're like, well, that's what I own. Now you could sell it, and then you're like, well, that's cash, and you're like, well, I don't know if I really want to own cash, especially for us. Our investors are paying us to invest their capital. Like if they want cash, they can own their own cash. You're not paying me to own cash for you. You can own your own cash. You don't need me for that. So I'm like, we're typically fully allocated or close to it. So I'm like, what do I do now? On the other hand, if I've got a long list and I know, oh, this is, that's how we found Argentina. That's how we found Chinese equities. Like we're always finding stuff, and we go like, that just looks way more interesting than some of this. Why don't we take 50% of this position off and start legging into X, Y, Z? Which also comes back. People often say, oh, when do you sell something? I'm like, that's when we sell something. When on a relative basis, you can see that this here looks a lot better than that there. So it doesn't become, it's not like a difficult choice. Do you know what I mean? It's like, it's very fluid. It's very easy. It's not like you're like, oh my God, I'm selling something at Tozoro, and do I sell it and don't? It's like, it's easy to take 50% off of a position that's up 5x. Like how hard is that?
Right.
And more than 50%. Like, so if you bought something at a 5% weighting and it's 20%, as we've had before, you go, cool, let's take 15% off. We've got a pile of cash.
Let's go.
Hell, we can go and buy 2 more sectors. What do we got? Oh, let's buy this, let's buy that. And you can still own the other 5% because maybe it's, until such a point we go, no, it's really just not worth it anymore. Let's kick that one out. And sometimes we do that too.
Do you find your ideas come from other people or headlines, or do you just have the stock screener running 24/7 and it's popping up magic sectors and themes?
It's normally stock screeners, and then it's
okay.
Yeah. I try not to pay attention to other people.
Good idea. Yeah. Okay, cool. Let's get into the next one. Maybe it's we got 1 or 2 more. This is the last one from Chris, actually. And he says, hey, Chris, hope you are well. BWLP has had a nice run since like the past 4 to 5 months. Its annual dividend is currently around 9. Has your opinion changed on the stock since its recent run? Would you reinvest dividends received at the current levels? Not at all, or perhaps wait for any potential pullback to add to these shares? Thank you, Chris C. All right. Chris M to Chris C.
Okay.
Who is BWLP, first of all?
It's marine shipping in Singapore.
Oh, gotcha.
It's still pretty cheap. It's like a PE of 10. And it's not expensive. Divi's like 10%.
Not bad.
Look, it's I don't see a reason to sell it, frankly. And so it comes back to I either have a reason to sell it, fine. Which I don't. Or there's something else out there where like that's much sexier. And I know it's cool, but like, and so none of those are present. So you just sit on it, you just hold it.
Hang out and collect those divvies and reinvest them like the champion you are. Okay.
Compounded 10% a year, you're killing it, man.
Dude, yeah. That's a no-brainer.
Yeah.
Okay, my man. We are all out of the queues for today. So congratulations and good job, everybody, for submitting your questions. Chris, like always, thank you for answering them. Any last thoughts, closing thoughts? Anything you're writing about that's on your mind? Seems interesting. You want to spill the beans on?
What I'm writing about, which I got to get into actually, and we just got it now. Record, because we just are publishing the last issue and recording our little video as soon as I jump off the call with you on that. So that will be in your grubby little mitts shortly, as soon as we can get it all done. Otherwise. I'm going to see you guys next week again.
That's right. We're moving it up a week. Yeah.
Because I'll be traveling, so trying to organize my schedule accordingly.
Good man.
But that's it. That's all I got.
All right, cool. We'll leave it at that. You have a wonderful weekend, sir. I know it's starting to cool down over there, right? Is it? Yeah.
Well,
Or heat
it's
up.
we theoretically we're coming into
Backwards there.
spring, and certainly the spring weather because we're in the southern hemisphere, so it's
Yeah.
opposite to you guys.
Yeah.
But today has been extremely windy, and now it's raining. But
We got one of these wild, like they call them haboobs, I think. These gigantic windstorms that come over. Very dramatic. It's like from The
yeah,
Mummy. The movie The Mummy, where
oh yeah,
comes across the Sahara like this gigantic wave of
yeah,
sand that just, you could see it looking out the window. You're like, holy shit, it's going to eat us alive.
yeah.
Pretty dramatic. It was like 2 days ago, 3 days ago. It was wild.
It must be quite
And
cool. Just
it
to,
is like from watching it, you're like, and it's not that bad when it actually shows up. You're like, oh, I thought I'd be,
does
suffocating
it
in
cover
sand.
everything in dust?
It's not that bad. It's like it's kind of like because it's monsoon season, so it's a little bit rainy, so it's not super dry, but it picks it up. Some of these storms get picked up, and there's this wall of sand that's probably like 500 feet, 1,000 feet in the air, and it comes across. Yeah, it looks like it's gonna just completely wreck your house, But no, it seems to be a little more tempered than I expected. But yeah, seeing it and then being in one is like two different things. Like seeing it on TV, going, "Wow, that's crazy," and then being there, you're just like, "Whoa, okay."
Yeah, yeah.
Yeah, the joys of living in Arizona. Anyway, buddy, good hanging out with you, man. We'll see you next week. We'll have another one next Thursday, and so we'll make sure that's all dialed in and everything's ready to rock and roll. And you have a good rest of your day, and we'll catch you on the next one. And bye, everyone.
Awesome.
Thanks for hanging out. See you guys. All right.